Hello and welcome back to my YouTube channel. So in this video we are going to learn about an economics topic from class 12th, and that is money and banking. It is not only important for class 12th, but yes, if you go on further ahead, you will study topics related to this in BCom, in MCom, in MBA. So it's an interesting topic, and if you clear it here itself in class 12, then the way ahead becomes very easy for you. So let's begin with this. So before money, the people used to trade, but the way of trading was different, and that name for the trading was barter system. So it is an old method of exchange where the people exchanged services and goods for other services and goods in return. If a person wants something, say apples, so the person, whatever he has, whether it's milk, whether it's wheat, shoes, it could be anything, but there was no money in circulation, so they used to exchange goods for goods or services, whatever they would like to. So where the economy where this system prevails, it is called a barter economy, or it is also called a CC economy. So here C stands for commodity economy. So you are exchanging commodity for commodity. There is no money in circulation right now here in the barter economy. So obviously this barter system was not so fruitful. That was the only reason why we got money in circulation, right? So let us see the limitations of barter system. So the first limitation is problem of double coincidence of wants. Let's take an example to understand this better. If there is a person A, let's name him as A. So he has got apples, and there's another person B, and he has got wheat. Now person B wants shoes, but person A wants wheat. So how will their wants meet? Because person A does not have shoes. So there was the problem of double coincidence, that both person A and B should meet their wants with each other, then only that settlement could take place. So we don't face this problem while we are dealing with money, right? Whatever you want, you just need to pay the amount and you get the thing. You don't have to wait for someone to get the same thing which you want or what you have, right? So let's check the next limitation, and that is the lack of common measure of value. So if someone has a kg of wheat and the other person has 1 kg of gold, so obviously if they exchange, there is a lack of value for that. We know that 1 kg of gold costs way more than 1 kg of wheat. So there was a lack of common measure of value. You cannot calculate wheat in terms of 1 kg of gold, right? So due to this limitation, we moved ahead to the use of money. The next limitation is lack of store of value. We know there are different types of goods. There are perishable goods, there are some which are non-perishable. But if you are dealing with perishable goods, if you store tomatoes for 6 months, what will you get? Rotten tomatoes after that, right? So you cannot store the goods for long and long. But when you talk about money, you can store it for as long as you want. So that was again a limitation of the barter system. And the last limitation was lack of standard of deferred payments. If from somebody I take some loan, and for now on he has given me, let's say 1 kg or 3 bags full of wheat, right? Now when I need to pay him back, how will I pay him back, right? There is a lack of standard for deferred payments. How can I pay him back again those similar 3 bags of wheat? That's not just possible, right? So that was the limitation which barter system had, and the money did not have it. Now let's talk about the present day thing, and that is money. So money, it can be defined as anything which is generally acceptable as a medium of exchange, and at the same time it acts as a measure, store of value, and standard of deferred payments. Now here in the meaning, in the definition, you can see it has got all those points which were the limitations of the barter system, right? So here it becomes easy to learn both the things. You can learn the definition of meaning, and at the same time you can learn the limitations of barter system as well, right? So it is something that is generally acceptable by everyone as a medium of exchange. If you want something, you can pay him or her money and you can get that thing or a service, whatever you want. And at the same time it acts as a measure. Yes, we can measure. So when we talk about it acts as a measure of value, it has a store of value. If someone gives us a loan of 1 lakh, we can obviously repay him the same amount, rupees 1 lakh, right? And it has a standard of deferred payments. If someone is giving me right now 1000 rupees, later on I can repay back and repay the same 1000 rupees, right? So money plays main 4 functions, and you can learn this in just one line. Money is a matter of functions for a medium, a measure, a standard, and a store, right? It is somewhat similar to what's there in the definition. So money has 4 functions which can be further divided into primary and secondary functions. I know though that it's not there in the syllabus, but yes, just for your knowledge, that it has got these 4 functions which it performs really very well, and it helps us to perform all the economic activities. Let's move ahead. Now we are going to talk about money supply. So money supply is actually the total money that is available in the economy. It refers to the total volume of money that is held by public at a particular time. So here when we are talking about a particular time, so it is a stock concept, right? When we talk about a particular period or over the time, that becomes a flow concept. When we talk about money supply, it is a stock concept because we refer to a particular point of time. So let's move and check the measures of money supply. So these measures, you need to learn them exactly. So let's see them. The measures of money supply, they are divided into 4 different parts: M1, M2, M3 and M4. So the first category, that is M1, it has got currency that is held by public, all the coins and the currency notes that the public has. Then the net demand deposits that are held by the commercial banks. The commercial banks, they also have the demand deposits which the people, they deposited there in the banks itself. And then we have OD, that is other deposits. Now these other deposits, what do they mean? So other deposits are the deposits that are there with the RBI, like financial institutions, World Bank, IMF, they deposit some or the other amount with the RBI. So these other deposits, they constitute all the amount that is deposited with the RBI. So M1 has got 3 components: currency and coins with the public, demand deposits of the public with the banks, and the other deposits that makes up the deposits that are there with the Reserve Bank. Now let's come to M2. M2 is equals to M1, all the components of M1 plus post office savings deposits. Now post office savings deposits have been included in M2 because these saving deposits, they don't offer check. They are moreover less liquid as compared to the banks, the accounts that we have in our banks. So they are included here in M2. Now we move to the third measure, that is M3. It also has all the components of M1 plus the time deposits of commercial banks. Time deposits are the fixed deposits that we have in our commercial banks. So M3 consists of M1 plus the time deposits that we have with the commercial banks. And finally M4. So M4 is equals to M3, all the components of M3, that means M1 plus time deposits, plus it has got the next component, that is total deposits with the post office saving organization. So again, M4 is less liquid as in when compared to M3, because it also has got the deposits with the post office savings organization. So that covers up your measures of money supply. Now let's move ahead and check what are the motives of holding cash. Why do we actually need cash in hand? So basically, John Maynard Keynes, he said there are basically three main motives that the people hold cash. First one, the transaction motive, where you actually deal in cash. You buy and sell the things, you need something, and for that you keep the cash in hand. So that's the transaction motive. Then the second reason is precautionary motive. Just like we just went through a lockdown, right? And that was quite a long one. So for precautionary measures, we keep money in hand because we don't know what might happen in future. If someone might lose job, so he needs to have that amount at home so that he feels at least secured for that. Or even you can relate it to the time of demonetization. So people, the ones who had cash, they were quite safe and they were relaxed, as and when compared to the ones who did not have cash with them. So people hold cash for precautionary motive as well. And the third and the most interesting one is the speculative motive, when the people think that they might get a chance to earn a little bit more from their cash. Instead of depositing that in the bank and get a fixed amount of interest, they feel that yes, here in speculative motive there are chances that they can earn more as and when compared to the interest rate that they are going to get in the banks. So these are the three main motives for which people hold cash with them. So that's it for this video, guys. Please do like and share my video and subscribe to my YouTube channel. Thanks for watching the video.